Good afternoon. I'm delighted to welcome you all here today and those of you who might be watching online to this LSE event that marks the launch of the State of the Corporate Transition 2025 report. My name is Carmen Nuzzo. I'm professor in practice here at the LSE, and I'm also the executive director of the TPI, Global Climate Transition Centre at the LSE, or TPI Centre for short. We are the academic partner of the TPI, the Transition Pathway Initiative, a global asset owners supported by asset managers with whom we share the same mission, that is to provide independent, rigorous, forward-looking research and data to encourage, enable, and support the transition to a low-carbon economy. I will be the chair of today's event, and I will guide you through the rest of the session. We will start with a few opening remarks by Professor Susanna Murato, Professor of Environmental Economics, Vice President and Pro-Vice Chancellor of Research at the LSE, and David Russell, the TPI Ltd Board Chair. There will be a presentation of the report's finding by Professor Simon Dietz, Professor of Environmental Policy here at the LSE, and also the TPI Centre Research Director. It will be followed by a panel discussion featuring investor, company, and policymaker voices, as well as a representative from a global independent environmental disclosure platform. And after a coffee break, there will be a closed-door workshop led by the TPI research team analysts to gain more familiarity with the TPI research assessment methodologies. For those of you who stay until the end, you're welcome to join us for a drinks reception. So we have time. Sorry, this should be working. It's not working. Sorry. Yeah, I did here. Thank you. Okay. Sorry, I was supposed to be on this slide. So we meet today at a time when the low carbon transition is facing real headwinds, and it is really easy to lose sight of progress. And this is why rigorous and independent data to track and assess the climate action of the entities towards which investors allocate capital is more in need than ever. Since the publication of the first corporate assessments of the TPI in 2018, the scope and the breadth of our research has grown significantly. And in response to investor demand, our focus has evolved beyond assessing alignment of net zero targets to the actual implementation of transition plans, and particularly their credibility, which is a key theme of this year's report. The results that we will present today are quite compelling. Our long-standing followers may have noticed that we have changed the title of the report slightly compared to its first edition 6 years ago. And it's no longer called the State of Transition, but the State of the Corporate Transition, because it will be followed by two more reports, one on the state of the banking and the state of the sovereign transition later this year, reflecting again the broadening of the TPI Centre research to ensure that we address evolving market needs, that our research remains relevant and, most importantly, actionable, because we want it to be used to inform your investment decisions and your engagement. You may also have noticed that the TPI Centre has a new logo, and we're now part of the Global School of Sustainability, and Susanna will explain what does this mean in practice. Now, a very short housekeeping rules for those of you in person here in the auditorium. In case of a fire alarm, please follow the instructions and evacuate the building as soon as possible. This event is live streamed. It will be recorded and will be available on the TPI website, technology permitting. Please be aware that there may be media representatives in the room. Also put your mobile phones on silent, and we'd like you to share thoughts on social media, but do not get distracted and stay with us for the event. And finally, there are colleagues who may be taking pictures during the event. We plan to use some of these pictures for our website or social media, so please let us know if you have any objections. Before I conclude, I really would like to take a moment to thank all the organizations that provide funding to the TPI Centre at the LSE, Climate Arc, the LSEC Foundation, FTSE Russell, and TPI itself with its asset managers and asset owners, who provide financial support. And thank you also to LSEG, TPI's data partner. And on a personal note, I would like to thank Professor Simon Dietz, who is the bedrock really of the initiative, and amidst his countless commitments at the LSE. Also, Valentin Ian and Antonina Scheer, who, for their loyalty, they're the longest standing members of the TPI research team, together with our PhD student, Nico Hastreiter, and they're really stepping up as their responsibilities within the center are increasing. Thank you to Ali Amin, who's the lead report author, together with Simon, and also to the whole research team, who is really stretched and works indefatigably, and to Kay Patalano, our our strategic outreach manager, Alicia Tauro, our project manager, and all the LSE colleagues from whom we drew support, including the editorial team, the events team, and also the research and innovation department. I would also like to thank David Russell, who should, in theory, be working part-time for the TPI, but he actually works more than full-time, and Professor David Webb, the chair of the TPI Centre's Advisory Board and Resource and Development Committee, as well as all the members of those committees that give up so much of their time. And last but not least, I want to thank the TPI supporters and the followers, because without your help, our work would be meaningless. So thank you. So with that, I'm going to pass the floor to Susanna. She is also an amazing ambassador of the TPI, and she's always been a great supporter of the TPI Centre at the LSE. So thank you. Sorry.
Thank you so much, Carmen, and a very warm welcome to everyone here today in the audience and also online. It's a real pleasure to be with you here again this year. I've been, I think, at every launch every year to launch the State of the Corporate Transition 2025 report. As Vice President of Research here at LSE, but also Professor of Environmental Economics, I feel a strong connection to the TPI and to the mission. It speaks both to my academic work, but also to my personal values. From this year, the TPI Centre is also part of our newly launched Global School of Sustainability, which we refer to as GSOS for short. The Global School of Sustainability is LSE's new flagship institute, bringing the power of social science to bear on the world's sustainability challenges. Working across the whole of the LSE community, but also with partners worldwide, academic and non-academic, we advance pioneering research to shape global policy for real-world impact. So the TPI Centre is no longer formally part of the Grantham Research Institute for Climate Change and the Environment. It is now a sister institute, and both Grantham and TPI sit under the umbrella of the new Global School of Sustainability. But the TPI will continue to work closely together with the Grantham Research Institute, as it has always done, towards delivering common GSOS goals. GSOS research is organized around 5 central themes, which get to the heart of the sustainability challenges that we face in our economic, our political, and our social systems. Sustainable growth, sustainable finance, political, legal, and governance systems, nature and biodiversity, and sustainable societies. The research that the TPI Centre conducts aligns with many of these themes. Today's event marks the launch of the State of the Corporate Transition 2025 report, but it is also a moment to take stock of the TPI Centre's achievements, which year after year are truly remarkable. The corporate universe that it assesses on management quality, with TPI's data partner LSEG, has doubled to more than 2,000. The number of sectoral carbon performance methodologies rose to 13 this year, with the new addition of the coal and chemical sector benchmarks, which are both key to the transition. New emerging market banks have been added to the financial institutions that the TPI is assessing this year, and the number of sovereigns will rise to 85, covering all the countries that are in major government bond indices. The pioneering work on Climate Action 100+ initiatives Net Zero Company Benchmark continues to shape investor tools and has spawned significant academic and grey literature. Notably, the Centre's cutting-edge research, designed to support real-world investment decisions, has continued toward widespread respect and influence. So this year, as an example, the new Net Zero Standard project, which focuses on company transition plans, won the ESG Assessment Tool of the Year in the category ratings by the 2025 Environmental Finance Sustainable Investment Awards. This follows a similar award that TPI had last year for the banking project and in 2020 for the management quality and carbon performance. Furthermore, the Centre has been shortlisted for 2 more awards. The Research Institute of the Year, which would be amazing to get, by the ED Awards in 2025, and for the 2025 award in recognition for action in climate by the Principles for Responsible Investment. In both cases, the winner announcement is still pending. So we're keeping our fingers crossed that we win at least one of these. The research of the Centre is increasingly cited, not only in market reports, testament of adoption by financial institutions, but also by policymakers. For example, in OECD, UNFCCC, and UK Financial Markets Review, and more recently, the work with the UK Transition Finance Council. This serves as evidence of how the Centre's outputs inform not only investors, who are at the heart, at the core of the initiative, but also have impact on policymaking and public discourse. Crucially, this year, we have seen further clear impactful evidence of how TPI resources actually drive climate finance. Over $100 billion in invested funds are tracking the FTSE Russell Climate Transition Indices that apply TPI Centre's assessments as a component of their methodology. The Republic of Slovenia issued its first sovereign-linked bond featuring one of ASCOR's indicators as part of the bond's structuring. And finally, last week, the first euro-denominated government bond exchange-traded fund was launched, using as benchmark a novel index by FTSE Russell, whose methodology contains ASCOR data as part of the inputs to weigh countries. Over the past year, TPI has significantly improved its outreach efforts through a variety of channels, including webinars, presentations, and public events. These initiatives have allowed the Centre to engage with a wider audience, increasing awareness of its mission, sharing its work more effectively, and fostering stronger connections and impact across the field. The TPI Centre has also welcomed a new PhD student this year. It now hosts 2. One is nearing the end of their program, and the other one is just beginning, and both work part-time for the Centre, thereby helping to train the next generation of scholars whose work will carry real influence and impact. This is an excellent example of how academia integrates with real-world impact. All of this, of course, would not have been possible, and Carmen already mentioned, without Simon, with his vision, his passion, and his unwavering commitment. And also, of course, without Carmen's outstanding leadership, steady guidance, and tireless dedication in ensuring that the TPI Centre's course remains true and its impact is ever greater. The Centre's remarkable achievements often defy the odds, pushing the boundaries of what is possible and enabled by funding that we do not take for granted. Echoing Carmen, I would like to extend my deep gratitude to all our funders, to the TPI Investor Network, and to all those who continue to devote their time and their efforts to ensure that the TPI Centre continues to reach new highs. Let me now hand over to David Russell, Chair of the Transition Pathway Initiative Limited Board, and representing the investors, our long-standing partners who are at the core of the TPI's mission. Enjoy the rest of the events.
Thank you, Susanna, and good afternoon, both in the room and online. And it's great to be here at the LSE again for a launch of another State of the Transition, State of the Corporate Transition this year report. This is the 6th of such reports. And firstly, I'm reading this because last year I got told off for overrunning, so I've got more notes this time. Yes, this is the 6th State of the Transition report since TPI was soft launched in 2016 and officially launched in 2017. The first report was in 2018, 105 companies from high-emitting sectors, coal, electricity, and oil and gas. 2019, we had 274 companies, 14 sectors. 2020, 332 companies, 16 sectors. Can you hear? 2021, 401 companies, 16 sectors again. Then there was a bit of a gap, COVID got in the way, and we then had 2024 last year, 1,027 companies across 17 sectors. And this year, management quality scores for over 2,000 companies. So significant growth over the small number of years, 6 to 8 years actually, since the launch. That 2,000 companies represents approximately 75% of global market cap of listed companies. So a huge proportion of the value invested, but also because it's high emitting sectors, the carbon emissions associated with publicly listed companies. That number will grow significantly this year as the next set of management quality data are published. So watch this space, hopefully for November, touch wood, that's when the data will be coming out. The state of transition reports, the corporate state of transition reports, provide an opportunity to look at both the corporate analysis that TPI does on management quality and carbon performance, but in light of other data sets as well. So for example, last year, the state of transition report looked at how company data can be linked to ASCOR sovereign or country-related transition data to show the link between how companies perform based on where they're listed, their home state. This year, we're looking at the report looks at links between management quality level 5 in particular, which looks at particularly focuses on transition planning, but also a focus on historic reported emissions and the maturity or not of the technologies or the levers that companies can use to address climate change and transition in the future. Simon will give the details of that analysis, so I won't go there. But what it does do is point at the credibility of some of the statements we're getting from companies, what they're actually saying they're going to do compared to what they actually have done. And you will have heard some of this before, but it's also my job here to say thank you to a range of different people. So firstly, thank you to Simon, Carmen and the TPI Centre team at the LSE, without whom we wouldn't have the data and the hard work that they do each year, not only on the TPI data, but also on the ASCOR data, the CA100 plus data, and the bank data that they also provide, looking at transition for a range of different sectors and asset classes. I would also like to thank the funders. I have no doubts about this. Without the funding that we get from Climate Arc, from the LSEG Foundation, from TPI's asset owners and asset managers, the research funding partners that we have, and from FTSE Russell, there would be no TPI. So it's really important that we recognise just how important those funding relationships are. And that relationship with FTSE Russell, London Stock Exchange Group, has been important since the start of TPI. They've been our data partners since then. In 2020, FTSE Russell, TPI, and launched the TPI Climate Transition Index, a collaboration between FTSE Russell, LGIM, I believe, and the Church of England Pensions Board. There was £600 million allocated to that fund. Now, as we heard from Carmen, $100 billion are run against indices which use TPI data. That's a huge vote of confidence into the quality of the information data that the TPI Centre is publishing. It's being used very specifically in asset allocation decisions to drive the transition. Lastly, I'd like to thank the supporters and the other people around the world, the other funds and organisations around the world that use the TPI data, because that's what we're here for. We're here to provide information and data that investors can use in their investment decisions to drive the transition. It's beginning to impact how companies are being engaged with, how investors are allocating their capital, how countries are being assessed for how they're transitioning. And the more that we can do to support that, the more information we can provide to asset owners, asset managers and other players in the field, the better. Now I'd like to hand over to Professor Simon Deeks, who has been involved since the start.
Thank you, David. It's great to be here. It's me. I won't add to the list of very important thank yous that have already been made, but I just want to acknowledge that this is a team effort, this report, and I just get wheeled out to present it. So credit has to go to the team, and this will go down in history as Amin et al. I'm just part of the al, so it's Ali's fortunes rest on my efforts over the next 25 minutes. So I'm very pleased to present the State of the Corporate Transition 2025. I'll just start by saying a few things about our methods and this report if you're not familiar with what we do. So we analyse companies' climate action. So what are companies doing on climate change? And we've established for a number of years 2 ways of doing this. The first one we call management quality. Is basically an assessment of what governance and management practices have companies put in place on climate change. The second way that we look at companies is something we call carbon performance. This is, loosely speaking, measuring companies' carbon footprint on a relevant basis and tracking how it's evolved historically and also what it might do in the future, and then comparing companies' pathways with low carbon scenarios that are essentially benchmarks that these companies should be aligned with. So this sometimes is called a Paris alignment test. Okay? So I'm going to be presenting data on both of these things this afternoon. In terms of the companies that I'm going to cover, as David has mentioned, this year we're pleased to expand our analysis to 2,000 companies in 24 sectors. There aren't 24 sectors in the table that you can see. It's not that we can't count, we've consolidated some of them. Our selection process is we prioritize high emitting sectors like electricity, oil and gas, airlines, cement, and so on. And within each high emitting sector, we choose companies in descending order of market capitalization, because that's a good metric for importance to investors, and investors are our core audience. So with the sample that we now have, we're covering virtually all of the market cap in the main high emitting sectors, okay? And approximately 75% of total global listed equity. As far as the carbon performance assessments are concerned, they're more intensive to do, right? Measuring companies' emissions accurately on a comparable basis takes a lot of time. So we do that just for a subset of 550 or so of the highest emitting companies. So let me present this year's results on management quality. So before I do that, just a few introductory remarks. So management quality is assessed based on a set of indicators. There are 23 of them. Each of these indicators you can think of as a management practice. The company is assessed based on whether it has that practice in place or not, yes or no. And then these indicators are used to arrange companies onto 6 levels. Steps of a staircase is literally how we visualize it. From 0, basically demonstrably unaware of climate change in their disclosures, through to level 5, where the company is starting to put together a transition plan. And so with that in mind, this is our sort of core chart to visualize the results of our management quality assessment this year. What you can see here is that most companies are on level 3, so about halfway up the staircase. So 55% of companies are on level 3. Level 3 turns out to be also the average score of all companies. If you turn this into a continuous variable and just compute the average. Forgive me for going a bit geeky, but we're in a university. So what does it concretely, what does it mean to get to level 3? It means that a company has acknowledged climate change as a significant issue, set a climate change policy, disclosed their scope 1 and 2 emissions, and set some kind of emissions target. So these are all important steps for companies to take on climate change, but there is a lot more that companies can and should be doing. So we think of level 3, possibly even generously, as par. We don't think of it as being good climate management. We think of it as being par. And on that basis, most companies are at par. About 22% of companies are below par, and we would think of them as being essentially laggards. And roughly 24% of companies are on levels 4 and 5 and are above par. And there are some interesting patterns at the sector level, which I won't go into today because I don't have a lot of time. So now let's break the data down to the indicator level. So here you can see the 23 management practices in their more or less full glory, okay? Arranged from the easiest ones at the top to the hardest ones at the bottom. And so the fact that the share of companies implementing each of these practices goes down as you go from top to bottom, that's not interesting, right? That's just an artifact of the methodology. It just says we've arranged it this way. But that being said, there are some quite interesting patterns that you can see here. In particular, as we've established in previous years, companies appear to be good at setting targets. Companies appear to be comfortable at setting emissions reduction targets. Companies are good at disclosing operational emissions, and they readily disclose at least some Scope 3 emissions. And there are other indicators that they do reasonably well on, including having board oversight of climate change and having a process to manage climate change risks. But on other indicators, companies do less well, such as aligning executive pay with emissions reduction goals, incorporating climate risks and opportunities into strategy, and disclosing an internal carbon price. The share of companies that disclose material Scope 3 emissions, NQ12, is also disappointingly low at 43%. I will return to level 5 later on, but it doesn't look pretty, does it? What about trends in management quality? How has this been changing over time? Well, the story this year is a familiar one. So we do see progress. So each year that we track this over the successive state of transition reports that we've published, we see more companies moving up levels than we see moving down levels. Okay? Interestingly, the average across all the 2,000 companies this year is actually slightly lower than it was last year. It's 3.0 this year. It was 3.1 last year. The reason for that is the effect of all the new companies here listed as 2023, not researched, okay? We know from our analysis that management quality scores depend on things like what sector a company is in and how large it is. And a lot of the companies that we've been adding this year are in sectors with low average management quality scores, and they are companies with small or medium market capitalization. So that essentially, I think, explains what's going on here. But for the companies that we've been tracking for years, we always see this slow progress, this gradual adoption of more and more of these management practices on average. Okay, let me say something about carbon performance now. So this is, remember, this is the other leg of our two-legged beast of how we analyze companies on their climate actions. So here we've taken the 500 or so companies that we assess, and we've tested their Paris alignment, so to speak, on 3 different timeframes. The short term, so 2027-28, the medium term, 2035, and the long term, 2050. I think the obvious headline here is that only a minority of companies have emissions reduction targets which would align them with the Paris Agreement goals. Whether that be 1.5 degrees, the strict the sort of the stretch target in Article 2 of the Paris Agreement, or whether it be below 2 degrees, the less ambitious end of Article 2 of Paris. So most companies are not aligned. Either they don't disclose enough data, they do disclose enough data and they are clearly not aligned, or at most they align with countries' NDCs, the national pledges, rather than the temperature goals. Alignment is stronger in the long term than it is in the medium term. That is largely a reflection of the fact that lots of companies have set net zero by 2050 goals, and fewer companies back those up with ambitious medium-term goals. So one of the things that we've been pointing to for a while in our analysis is really this relative, alignment is not great on any time frame, but it's particularly bad in the medium term. We can track trends in carbon performance just as we track trends in management quality. The story here is similar, even actually a little bit more positive than management quality. What we've seen over the years that we've been doing this is a significant increase, actually, in the share of companies that have Paris-aligned emissions targets in the long term and the medium term, both 1.5 degrees and below 2 degrees. So up from 9% in our 2020 research cycle to 30% in our 2024 research cycle, and that's also a much larger sample as well. So you've got two things going on there, an increasing share and a larger, more representative sample. So we do see progress here. But how do we make sense of this issue of alignment on different timeframes? Well, last year, we introduced cumulative benchmark divergence as a way to aggregate across these different timeframes and analyze a company's alignment with the Paris goals over the coming half century. Okay, so cumulative benchmark divergence, it can be a bit of a befuddling concept, but it is essentially taking the area under the company's pathway and comparing it to the area under the benchmark pathway. And positive is bad and negative is good. The other thing that you can do with cumulative benchmark divergence, which is really useful, is you can use it to construct portfolio level measures. So you can calculate CBD at the company level, then you can aggregate that to the sector level, and then you can aggregate sectoral CBD to the whole portfolio level. And this is really important because at a portfolio level, you can allow some companies to overachieve and some companies to underachieve. And having that flexibility is going to make the transition affordable, right? Rather than imposing the same reductions on all companies. That's me with my economics professor hat on, always banging on about efficiency. So these are the results of calculating cumulative benchmark divergence across sectors and for the whole portfolio, okay? Both compared with 1.5 degrees and below 2 degrees. The two numbers to really focus on here are 61 and 13. Okay? So for all the companies that we can analyze in this way, and this is about 375 companies because we can't include companies that don't disclose in this analysis, so it's a bit of a smaller sample. This portfolio of large emitting global corporates exceeds the 1.5 degrees cumulative emissions budget by 61%, okay, which is a large margin. And I guess not surprising. What is also disappointing, but I guess in some ways a little bit more encouraging, is that the cumulative exceedance of the below 2 degrees benchmark is only 13%. Now, as I mentioned, this is a small-ish and not necessarily fully representative sample of companies, but it is a set of many of the world's largest and highest emitting companies. And I think overall these results are similar to analyses like Climate Action Tracker, which try to project global emissions from all sources forward into the future and look at whether we're on track with 1.5 degrees, 2 degrees, and so on. It's telling a story that says that we're miles off track for 1.5, and we are off track for below 2 degrees, but not that far off track. Okay, so glass half full, half empty. I leave that to you. Okay. For the last part of my presentation, I have little idea of how much time I've got left, but I think that's a good thing. So carbon performance is particularly the forward-looking part of carbon performance rests on companies' commitments, their emissions targets. Things like, we want to be net zero by 2050. And of course, the question naturally arises, well, how serious are companies when they make these kinds of commitments? How credible are these commitments? And this has been something that we've been thinking about for a while. I think it's really at the cutting edge of what everybody in this space is trying to do right now with methods and metrics. What I'm going to describe to you today, what we have in the report, are 3 ways of looking at whether companies are credible about decarbonising. Okay. So firstly, I'm going to focus on management quality level 5, because management quality level 5 indicators are specifically about whether companies have credible transition plans. Second thing we can do is we can take our carbon performance data, and instead of using it for the forward-looking analysis, we can use it for the backward-looking analysis and ask if companies have been reducing their emissions in recent years and how fast. Colloquially speaking, are they already walking the talk? Are they decarbonising? How quickly? And the last thing we can do for a set of the largest emitting companies is we can look at their climate disclosures. We can look at how they describe what they're going to be doing to decarbonise, and we can assess how mature the technologies they say they are going to rely on actually are. So let me go through each of these, but before I do it, I really want to stress that this is work in progress. I think there's a lot more to be said on credibility, but I think this is going to produce some interesting insights. Also, I have to admit to you, I don't feel like I have a tight story about all of the results I'm about to present. Okay, so I'm kind of in brown bag seminar mode for the next 5 or 10 minutes. This is going to be aggressively uncommercial. So I'm very happy for you to come to your own conclusions and help me get my story right on what the following says. Okay, so management quality level 5. Okay. So, well, it's not difficult to come to a conclusion about what this says per se, right? It's dismal, right? So here is a set of indicators asking whether companies have credible, detailed climate transition plans. And we didn't pick these indicators out of the ether, right? These arguably represent what the community thinks of as a credible transition plan. Different initiatives like Climate Action 100+, Transition Plan Task Force, and that kind of thing. So I would argue that these are a representative of what the community thinks a good transition plan looks like. And you will see that hardly any companies satisfy these indicators. No company satisfies all of them. Not more than 10% of companies satisfy any of them. So if this is our measure of credibility, you can forget it, right? But of course, we might say that, well, the notion of transition plans is relatively recent. Companies might need time to comply with the norms of transition planning disclosure, and therefore, how much should we expect them to do on this so far? So on to the next thing. So what we're doing here, so we've got 8 sectors. These are companies that we have carbon performance data on. We're tracking their annual rate of reduction of their emissions intensity. That's the height of the blue bar. And we're comparing it with how fast they would need to reduce their emissions according to the low carbon benchmarks. Now, that hopefully you understood that, but just to make it a little extra hard for you, we've actually put 2 sets of benchmarks here. The solid yellow dots are the benchmarks as of 2020. In other words, this is the information companies had in 2020 about how fast they would need to reduce emissions to comply with the Paris Agreement. Okay. The hollow yellow dots, is that the right word? Right? These are the benchmarks that we now think of, right? Given that we've had several years of exceedance of the Paris goals, right? This is how rapidly companies would now need to be reducing their emissions over the next few years. So this is all with respect to below 2 degrees. What you can see here is actually you know, reasonably encouraging. So actually most sectors have been reducing, the average company in most sectors has been reducing its emissions intensity faster than the below 2 degrees benchmark for that sector would require. The only sector that is clearly not achieving that is oil and gas. For steel and electricity utilities, they have been decarbonising faster than their 2020 benchmarks. Once those are sort of recalibrated for how fast we now need to reduce emissions, they don't quite get there. But this is, you know, maybe not such a negative picture, and perhaps quite in contrast with this. I'll just put that out there. But when we re-benchmark this against 1.5 degrees, you get a much more familiar pattern. So for most sectors, the blue bar is above the triangles. That means that emissions are not being reduced fast enough. There are two exceptions here, airlines and shipping. The airlines data is really distorted by the COVID pandemic, so I wouldn't pay a lot of attention to what's happened to airline emissions and emissions intensities over the period. The shipping data are probably meaningful, but reflect the fact that the big publicly listed shipping companies are much cleaner than the sector average, right? So there's something specific going on there too. But this is obviously more pessimistic, and it tells you we're not reducing emissions fast enough for 1.5 degrees. We knew that. So the last analysis is the decarbonisation levers. Okay, so what does this slide show you? So on the vertical axis, you have different kinds of decarbonisation technology, right? Renewables, hydrogen, biofuels, so on. On the horizontal axis, you've got different sectors. The size of the circle in each cell of the matrix is what proportion of companies disclose that they're going to use this technology to decarbonise. The colour of the circle is the IEA's assessment of how mature the technology is, right? Green means mature, red means far from being mature, right? So you can see some things that would make sense to you. Renewables is a mature technology. Process efficiency is a mature technology in some sectors. Carbon capture and removal is usually an immature technology, as is, and there are some other specific technologies which are immature, like electrification in airlines or hydrogen in steel. What is this matrix telling us? I've actually spent a lot of time trying to figure this out myself, so it's frankly slightly risky putting this thing up, but I've had a lot of chats with Ali about it, and that's been very helpful. He's set me straight, okay? So one thing to say is that this probably, in some ways, this just embodies the nature of the transition. Companies are disclosing that they're going to use lots of different decarbonisation levers. Some of them they're going to rely on in the short term, some of them in the long term. This matrix collapses the time dimension, so you don't see that, right? In the short term, they want to use the mature technologies and renewables. In the long term, they might need to rely on more speculative technologies. I think what this analysis, though, is really useful for is basically identifying where are the red flags specifically. Okay? The red flags here are the red circles with the boxes round them, okay? So things like the need for process efficiency in cement, which I think is basically dealing with the emissions from calcination, right? I'm looking at my team to nod furiously or shake their heads, right? Okay, so I'm getting nods more than shaking. Electrification in airlines, that doesn't need much imagination to see that that's immature at the moment. Carbon capture and removal in oil and gas. So a lot of oil and gas companies wanting to deal with their long-term emissions through carbon capture and removal, and hydrogen in steel, right? So this kind of analysis gives you some traction on where are the technological dependencies here? Where is decarbonisation appearing to rely on immature technologies? And it follows on from that, you know, what can we do to make these technologies work? So let me summarize, because I'm almost certainly over time now. So I've showed you our core results on management quality and carbon performance. So on management quality, we see continued progress, but we see the rump of companies halfway up the staircase, right? doing the basics, but lots more that they can be doing. On carbon performance, we see cumulative exceedance of 1.5 degrees by a large margin. But as far as below 2 degrees is concerned, companies are off track, but not as far off track. In terms of the credibility analysis, well, if we think of credibility as having a credible transition plan, then they're just not there. We just don't find them. If we think of credibility as reducing emissions in reality, then we see some green shoots, so to speak, but we're clearly off track for 1.5 degrees. And if we think about credibility as not relying on speculative technologies, then there are some specific red flags coming out of that analysis around things like the proposed use of carbon capture and removal and so on by the oil and gas industry, the proposed use of electrification in airlines and so on. So that is the end of my talk. I just need to get through 3 slides of promotional material. Firstly, I want to remind you, if you haven't already seen our social media activity, we have a new discussion paper with a carbon performance methodology proposal for chemical producers. We're very proud of this. Chemicals is a very hard sector to assess. If you're really interested in the nuts and bolts of benchmarking company emissions, I encourage you to read it. And we are actively looking for feedback on this methodology before we roll it out properly. So now, State of Transition, it used to just be one report, it's now a trilogy. So I'm presenting corporates. Today, next month, we'll have our State of Transition for banks. And then in November, our State of the Sovereign Transition report. And here is world domination in 3 bullet points. So we're continuing to scale up our tools and expanding the number of companies, banks, sovereigns, even trying to expand the number of asset classes that we're assessing. Besides going broad, we're also trying to go deep. So we're working on some quite detailed net zero assessment frameworks for specific high emission sectors. And we're becoming, we're trying to be increasingly sensitive to the regional and policy contexts and working on ways to reflect regional nuances in our analysis. So thanks so much for listening to my talk. And I think we're going to go, there's the disclaimer, by the way. And I think we're now going to go into the panel.
Thank you. Simon will be available for questions during the panel, but I would like to invite our esteemed panelists to the stage, please, now, and get some quick reactions to the report. So if I could have Sherry, Chris, and oh, you're behind. No, okay, and Mardi. Thank you. We're trying to connect the investors joining us for the panel. So the plan is really to get a quick reaction to the report from all of you. I'll introduce you in a second once the technology allows us to, for Claudia to be on the screen. And then leave as much time as possible for the audience to ask questions. So perhaps whilst they figure out how to bring in Claudia here, I'll start by introducing Mardi McBrien, who's Senior Director Enhancing Corporate Performance and Accountability at the World Business Council for Sustainable Development, which she's recently joined. But she brings a wealth of expertise with over 15 years of leadership in sustainability, disclosure, and reporting. And most recently, she served as the chief of the Strategic Affairs and Capacity Building at the IFRS, the International Financial Reporting Standards Foundation. So Mardi will bring to the panel the perspective of companies. And then I'm glad that we have online now Claudia Cruz. She's Managing Director for Responsible Investment Strategy and Partnership at APG Asset Management, which manages over 400 billion of euros on behalf of Dutch pension funds. Thanks, Claudia, for joining us and for waiting patiently. We also have Sherry Madeira, sitting on my very left, Chief Executive Officer, CDP. She's a prominent thought leader on sustainability with a focus on sustainable finance, environment, data, and public policy. So she brings the perspective of a leading independent environmental disclosure platform. And last but not least, Chris Skidmore, who's chair of the Transition Finance Council Working Group #2, Pathways, Policies, and Governance, and also chair of the Centre for Economic Transition Expertise, CTEX for short, here at the LSE. Chris has covered illustrious roles as a former UK minister, notably the one that saw him signing the UK's net zero commitment into law in 2019, when he was UK Energy and Clean Growth Minister. So welcome to you all. Let me start perhaps with Claudia, who's been waiting patiently online. Claudia, what we do at the TPI Centre, the research and the data that we produce are meant to be investment decision useful. We really take these opportunities as the State of Transition report to dig deeper, going beyond the pure annual score assessments. What's your quick reaction, and what stood out the most to you of the report?
Yeah, thank you very much. And can you hear me okay?
Yes.
Great, good. Yeah, so first of all, I was asked to briefly introduce the company I work for, since we're not a household name. So we are a fiduciary manager for Dutch pension funds, and by now we manage about 590 billion on their behalf. And our clients, the pension funds, have very strong climate commitments. That is around reducing emissions. It is about using the net zero investment framework, but it is also about investing in climate solutions. And I think, and it was a brilliant analysis that was just shown now. So first of all, we are also a partner of the Research Council of TPI, because we consider the data and the research that we receive very, very important in our own approach to assessing companies that we invest in. And I'm very glad to see the continuous focus on extending and deepening the work from the TPI. Likewise, we are not only invested in equities, but also in sovereigns. So the UScore tool is one that we equally applaud and use. But in terms of a quick response to the report, of course, what was encouraging is to see a reduction in emissions intensity overall, and by some sectors more than others. That is clearly encouraging. What I thought in terms of the level 5, the management quality indicator, I thought that's a very interesting one. This morning, I hosted a roundtable with supervisory board members of Dutch companies and the chapter 0 in the Netherlands. And of course, there in the boardroom, how do you really look at the governance of the transition and governance of climate change is a key topic. Therefore, I would hope that we can go deeper into assessing what the management quality means. And when my colleague Joanne and I were going through the report, we noticed the aspect around CapEx. And the indicator there is that all CapEx is aligned with decarbonization. And we were wondering, if one looked there at whether perhaps the majority was aligned, whether any other findings could be revealed. So that was one of the aspects to look at. And then perhaps what really struck me is the assessment on the commercial viability of the technologies that are being used, and how there was the distinction between sectors where there are more mature technologies available and where there aren't. And that also would bring me then from an investor's perspective to the focus on investing in climate solutions, and that could well also be in this technology space.
Great. I think your point about bringing the analysis at the boardroom level and what companies really make out of it, and also the commercial viability of the technologies available is an important one, because sometimes maybe companies might be reluctant to share also for competitive reasons certain details, but definitely CapEx is a key metric that we ought to be having more transparency about. Perhaps, Marty, I can bring you here as a representative of the companies. And what Simon showed in the report was that the management quality score overall has remained roughly stable, but there has been some improvement in the degree of the alignment of companies to the Paris Agreement over the long term. So even if not enough to reach the 1.5 degree scenario, but not necessarily short term and medium term, then this is really where companies are struggling. So with that hat on, what would the companies that you represent say to that challenge?
Thank you very much. And it's a real pleasure to be here. Great report, by the way. It's already gone around the whole organization, and Peter Backer himself wrote to me this morning to say, really good report. So congratulate them. As part of your remarks today, he saw it, and I can share the email. So
and I saw that yesterday you published one on technology dependencies, which is what Simon mentioned earlier. So that's great.
we did. But what we see across our members, and it isn't that companies are actually stepping back as it might seem from that sort of longer term commitment. If for those of that saw during London Climate Action Week, we launched the Business Breakthrough Barometer for 2025. And what that showed is that most companies are still committed to sustainability despite these challenges. But in the face of the rising uncertainty, which I think everyone in this room is very familiar with, we're seeing that they're targeting actions where the conditions are right, where they're increasing investments in this space, transition-related investments, and leaning in harder into the emission reduction targets, but in the much more in sort of the longer term alignment rather than that near term action. And there's reasons for that. And one of those is around capital planning. They budget 3 to 5 years out, getting that CapEx procurement, the roadmaps in place really quickly. It's just really, harder for them to do, and they're constrained again by their own limited resources. We're also seeing, but sometimes we jump straight to that corporate investment, but sometimes we need those enabling conditions in place, those policy enabling conditions to help get there. And we have civil society at the moment promoting that, if you do not transition, your costs are going to become stranded. But actually, stranding assets is not asymmetrical. If you can't leave them behind, they'll become worthless. However, for those that get ahead of policy and it changes, for example, and we've seen recently the omnibus, those that moved ahead very ambitiously, complying with what they thought was coming out of the EU omnibus. We've seen a lot of people lose jobs and come backwards, from that. But again, the wind farms more recently in the US, when they were largely counted with 90% complete. Without that enabling environment, policy context locked in, that has real implications for those getting out ahead there. We also need the clear market signals. They are mixed at the moment, and we are launching a white paper on this imminently, I'm told. So watch this space. The team are really busy at the moment. I've joined a really busy team, which is really good. But looking at sustainability and does that impact company valuations, to really open up this discussion piece. And we're also things around, Simon mentioned technology earlier, and we're working with you. We talked about that during London Climate Action Week and what we needed to do to support that piece. And that's where our new report that you kindly cited on transition plan dependencies came out this week. So how can we further support around those dependencies and guide companies our members and companies in that direction? And we've had a huge amount of support already from asset owners and asset managers and banks towards the direction we're taking that report. So there is a lot, I think, in this, but I think the general will is there. There's just quite a few blockers or stacks that we have to kind of unpick on our way through.
I'm conscious of the fact that perhaps what we're asking for now would not have been even imagined 5-6 years ago. So it is perhaps the right time now to put the finger in the right spot, whereas before these questions would have landed unheard of, because neither the investors would have been equipped to address them anyway, nor the companies to address them. And Sherry, you work at CDP, which is being a long-standing platform way before the TPI started gathering data to enhance transparency on environmental disclosure. But you also, just like us, have added new questions to the questionnaire reflecting this evolution of the market, particularly on transition plans. What have you found in your reports that chimes in with what we have found, and do you see any area of complementarity?
Yes, thank you. Thank you, Carmen. And I'm going to add my voice saying that this is a great report at an important time. Because I think that, we talked a lot about targets, and in today's environment, we could also talk about corporates thinking about, shying away from some of the difficult targets. The reality is that transition plans are being established, and that is part of a business plan, not just thinking about net zero or thinking about this as separate from core business. And a lot of our questions are reinforcing that, Carmen. We actually have 25 years worth of data. And the transition related data, we started thinking about what is it, the word that I think you used, Simon, was credible, and credibility is coming through. That was something that we at CDP started about 6 years ago, and we identified 21 different data points that the logic was if companies aren't disclosing those data points, how could they be on track to start achieving their targets? How could they be relating to a transition plan if they're not even tracking some of those simple things? And I've got some bad news, which is that as of last year's data, about 1% of all the companies that disclosed to CDP had credible transition plans. So there is some ways to go. However, we also have some good news, which is as of last year, 25% of companies that disclosed to CDP had transition plans. So again, we're on a journey. I think that is a key point to make, which is as we're moving from year to year, we're seeing an increase on the credibility. We're seeing an increase on thinking about how transition is the next step. Targets are no longer good enough. And that 25% of companies, that raised by 44% year on year. So again, the acceleration is coming. I'm delighted to be excited giving some more data in the coming weeks. Today is the last day for CDP's disclosure cycle to be open. So anybody who has any fingers above a button, hopefully none of you in the room, but maybe some of you online, certainly that is part of actually building up this journey, is understanding how that disclosure happens. And of course, with a majority of the world's market cap reporting to CDP, over 25,000 companies, all sectors, all sizes, we have an SME questionnaire. It's something that makes a difference. So Carmen, what we're seeing is, the news isn't wholesale good, but it's going in the right direction. And if we keep thinking about that journey, I think that there's a lot of good things we can talk about.
Which echoes very much Simon's message of the glass half empty and half full. The problem is that we haven't got that much time on our side. And actually, perhaps thinking about time, you raised a good point, Mardi, about this disconnect that there is in the business cycle, time horizons versus the policy cycle and investor cycle, and they don't coincide. And perhaps turning to you, Chris, this was one of the themes that we discussed as part of the work that we did together at the Transition Finance Council working group. Your contributions have always been amazing in trying to connect investors, policymakers, the private sector and public sector. With that hat on, what would be your take on the report?
Well, I think the report quite clearly shows that it's not just about technological maturity, but also policy maturity, where you see the ability for companies to move forward. They've done so under the supportive wing of government policy that's stable. The net zero review that I published in 2023 talked about the 4 C's, the continuity, the clarity, the certainty that's needed for investment to flow. And I guess the challenge for is to look at, are these companies, are these externalities that they are facing that they cannot deliver what they want to achieve, or is this within the company's gift to be able to change what they want to achieve? Because particularly when it comes to funding the capex and the investment, obviously for transition finance that you may have been focusing on, thank you so much to TPI and LSE for helping to work on the finance playbook that we sort of published on Monday. is there the capacity and the capability within these companies to be able to actually at the moment have the policy certainty to develop what needs to happen? And obviously that's not quite clear for some technologies at the moment, that they don't have sort of cap and trade mechanisms that are going to work for them. When I was energy minister, I published the first green finance strategy back in 2019. When we had the transition finance strategy that's been published by governments, we're playing catch up, I think, with a number of areas of policy. But then also, there may be companies willing to make the move, but the financial environment at the moment is not possible for them to be able to actually unlock that investment, to actually achieve that investment. And that's something we're really keen to be focusing on as part of the playbook, setting sort of criteria, particular conditions, principles that should be followed in order to make that sort of process easier than it currently is. Because in areas like cement and steel, huge capex costs, the purse strings are not being unlocked at the moment, because they're not able to necessarily have that mature benchmarking on some of the data to be able to prove what the trajectory is, what's the opportunity for the investors to come in. And that's, I think, also a responsibility of government, aside from setting some of the policy frameworks, is around some of those wider investment frameworks that they need to also back sector transition plans. I know we've been speaking about companies here, but once you start adding these all up into a wider sector, this is a great moment we've reached at the moment. It's fantastic that we've got more companies than before wanting to do transition plans, but we're at a fork in the road. We either go one direction, where lots of different companies do lots of different things, or they come together as a sector to outline what their overall sectoral need is and how it's going to align with 1.5 degrees or 2 degrees, and the government supports that. And that act of co-creation between government, business and the financial sector is obviously a key recommendation that we've been taking forward as part of the Transition Finance Council. I know also, the TPI are really keen to work on that, but it does require, almost a safe space and an independent location by which to develop some of these sectoral transition finance plans and transition plans, rather than just the companies marking their own homework, using the data that CDP provide and everything. So that's fantastic. But there's clearly a trust and credibility argument, because the companies themselves, are willing to create an image of success that's not necessarily based in reality.
You talked, President, very importantly about this co-creation, and we need to address the problem of the coordination and the collaboration. Right? We as an academic space, we offer a safe venue to have those conversations. But you also talked about having the right conditions in place at the right time. Simon clearly showed with the chart on the cumulative disclosure benchmark that we are way off track at the moment, and but also that the carbon budget is shrinking, and so the degree of decarbonization that is needed today, as opposed to the one that would have been needed a few years ago, is much faster than otherwise. And I have a question for you all related to the fact that, in a way, all the low-hanging fruits perhaps have been exhausted, and companies have already used low-cost efficiencies. And so we're at the point where we really need a transformational exercise of the true operations of the companies. What would be the right conditions to enable that to happen? And perhaps, Simon, you can come in here as well.
Certainly, and I don't want to sort of cut across what my fellow panelists are likely to say. So I think I'll just offer 3 high-level points, which they might subsequently pick up on. I mean, I think one is that, as Chris said, we need predictable and appropriately ambitious policy, because this is a market failure. The incentive for individual actors to free ride on others is very strong, and so without that policy framework, it's quite difficult to move with the requisite speed. Secondly, mobilization of capital in support of decarbonisation, and thirdly, implementation by corporates.
Anything else that you would like to add?
Yeah, happy to jump in. In some ways, we have to kind of say, so what for the corporate, right? So why does it matter to the corporate? I think everything that we're saying is absolutely correct. With the data from the report starts becoming very grim when you look at the risks for the world. But what are the risks for the corporate? And if we can start answering some of that question, then we can start balancing risk and opportunity. And Chris, your point is really well made, which is where is the opportunity? And CDP has been asking some of these questions for a number of years. So last year, 64% of respondents to CDP said that there was a upside, a revenue or a business opportunity financially in order to be able to execute a sustainable business plan. So what does that mean? That means $1.3 trillion was identified last year from those that responded to CDP alone. You might say, well, actually, that means that there's going to be a lot of money that has to be spent to release that 1.3 trillion. The ratio is 7 to 1. So you gain $7 for every dollar you spend. That is investable. It's a question of how is it that we can start turning the narrative into something that becomes core business. The targets and the transition plans are absolutely essential. And what it should do is spark the excitement of some opportunities that become absolutely core business opportunities, because that is going to actually be the stickiest path forward.
Yeah, your point, Sherry, about changing the narrative, I think is quite important. Is it more than transition plans? Perhaps we should be talking about strategic plans when we talk to companies, and then the music will change in a way. Chris and Marty, would you like to?
So I think this event's really well timed. It's in about less than an hour and a half. I think the government's consultation on mandatory, whether transition plans should be mandatory, will close. So if anyone's sort of, you've got just enough time to get your entry in. I know that sort of, CTEX and TPI have put their own sort of formal submissions into the consultation. But whatever, there's two elements here. One is that the consultation ends up sort of, saying that transition plans should be mandatory for companies. It may or may not do that, or it says that there's got to be some sort of comply or explain sort of regime, but there's definitely going to be a policy shift that's going to happen. Now, with that, I think creates a sort of social contract that needs to take place between government and companies. You can't just say, right, you've got to do it without also providing additional guidance. So I think, the work that the report shows is that companies, is whether they have the capacity or capability or simply don't have the ability to know how to plan on a 1.5 degrees pathway, that the government needs to step in and provide that support. And obviously, that's on the emissions basis. And that's obviously vitally important for sort of demonstrating the entire purpose of transition planning. But then the point Sherry makes is also the government has a responsibility also for demonstrating how transition plans can unlock this financial opportunity and give companies the ability to do so. The playbook that we've published for the Transition Finance Council recognises that interdependency between companies, sectors and national policy. And actually, we've got to be able to recognise, just in the same way that slide showed actually how this report in itself creates sort of feedback mechanisms where more companies have been able to join, and then it creates more finely grained data by which then you're able to make better informed policy choices. Transition planning itself can't just be sort of set in aspect. It's got to be this ability to be able to refine, to be able to come back, to demonstrate how transition plans, yes, some of the companies have not produced accurate transition plans. That's not necessarily a bad thing, because it gives them the opportunity to build and refine and then do the correct things. They've at least started on their journey, just in the same way the government started on its journey from net zero. It's made plenty of mistakes. There are opportunities for the government to recorrect them in the carbon budget delivery plan that's coming up in October. Transition planning needs to be front and center also, I think, of that. And hopefully by October, we'll have more policy certainty of then how the future of transition planning, the role the government plays in providing not just certainty, but also standardization. It's really important.
I'm glad that you mentioned the national plans and the companies plans, because they have to be connected somehow, and that element of predictability, Simon, that you mentioned is really important to make these business plans viable. Marty, before I come to you, I just want to ask Claudia, who's online, if she wants to chime in on this point, how important it is to you as an investor to have this element of predictability to increase your confidence in where you are allocating capital towards.
Yeah, the element of predictability is very important for us as investors, in particular because we are also making some very long-term investments in infrastructure investments and the like. So that is a key point. And what I wanted to pick up on is the point of the social contracts as well, because the social contract from an investor perspective is also with those on whose behalf you invest. So that investments in the livelihood of the beneficiaries on whose behalf one invests are increasingly becoming important as well. So that climate-related, energy investment-related investments also happen at home to secure a sufficient impact.
Yeah, in the Netherlands, we definitely have an excellent example of that. I think, Marty, very quickly, because I would like to also open the floor to the floor to questions from both here, people on, and also people online. So start thinking about your questions, please. Yeah.
So I can touch this really quickly, and Sherry did briefly talk about this before, but the idea of actually transition plans just actually really need to be part of everyday business strategy and operations, right? Like every other conversation is across the business. And when we go, across the world, we move across into Asia. We had a big deep dive in India 2 weeks ago with our CEO, Peter Bakker. We started talking about transition plans. They're like, they don't know. This is just part of our strategy. This is just part of our business planning. This is the part of the way we just get on and do business. And so, sometimes we talk about transition plans and as a standalone exercise, but actually, if this is really going to happen at scale and pace we need it to, it needs to be an extension of core corporate strategy and financial planning. And then across the governance, R&D, it comes right across the business and flows out through that. And we're looking at this at the moment, but also right across, adaptation, embedding nature in the plans, the just transition part of transition, and working out how we provide guidance on all of this together to business so it can be incorporated in as one going forward. And for those in New York, let me know, we are running an event with ERM on Thursday next week, really exploring this and digging in on it. So yeah, do let me know, because we'd love to have you along to talk about that with us.
Sounds to me that there is probably a lot more going on than what the data might show. Just that we need to provide more venues to talk about this and be more open about this. So with that, I would like to start maybe by taking a couple of questions here from the audience, and then we'll turn to those of you who are following us online. Can you please raise your hand and state your name and affiliation, and pose any question that you might want to ask the panel? Who would like to be an icebreaker? Thank you.
Very much. Great. Great to hear everything you all say. My name is Jessie Younger. I'm from CCNA Investment Management, and together with the Local Authority Pension Fund Forum, we've been co-leading an initiative asking companies to put their climate transition plans to vote at AGMs. We're going to the 5th year for this initiative. We have 1.6 trillion supporting last year, got over 2 trillion this year. And I tell you what we thought of this mechanism. I think picking up on 2 points, A, that it's part of the main business strategy. That should be reviewed by shareholders. Secondly, it allows that CapEx element, capital expenditure, what you're going to be spending to implement the strategy, and allow shareholders to review it. And just that it should be a standard part of discussion at AGM. So, yeah.
Do we have another question? Yes, please, here at the front. Thank you.
Hi, George Nodi, JP Morgan Asset Management Sustainable Investing Team. Question for Chris. To what extent do you see the government doing the hand-holding to the industries being led by the government or being led by industry associations? For instance, in the US, the Edison Electric Institute just published the EPRI standards, which guide US utilities companies. But that's not necessarily a government initiative, that's more of an industry collaboration. So to what extent does the government step into these kind of sectors and lead on that end?
Chris, maybe do you want to start?
Yeah, I mean, I think we've tried to address this in the Transition Finance Council, because already there is a sort of emerging strategic ecosystem for advising the government. So the Net Zero Council sits as the sort of overarching industry-led body, which is developing transition plans for sectors such as sort of housing, agriculture, and there is a bit of vested interest there, because there's a number of sort of trade associations that are helping to work with that. I mean, my challenge is, how do you stop these things just being sort of lobbying exercises, which is why we've recommended having, that sort of independent space to be able to make sure that the data is being handled correctly, and also that the plans are being sort of, can be trusted and credible. And that's where we want to work on the finance part of the Net Zero Council. We also agreed on Monday a statement of collaboration between our Transition Finance Council and the Net Zero Council, yeah, the idea is that obviously, departments, and I've been there as a minister, they have their areas of focus. You've got hydrogen team, CCUS team, they're these core groups of 10 civil servants usually who are working, beavering away at this sort of stuff. But they do require ministerial direction. Obviously, ministerial direction comes from that engagement with the trade associations. What I'd say, and I think it's also, World Business Council Sustainable Development, I think you also with the RM launched a paper on long duration energy storage.
did.
We're actually going to be focusing on long duration energy storage as part of our next sort of piece of work to apply the principles of the playbook, the finance playbook, because there isn't a trade association for long duration energy storage. One of the challenges I think is really interesting to come back to the policy certainty is obviously where you had like mature industries like renewables or house building, they've got now the policy frameworks, or the car industry, they've got the EV mandate. What we need is sort of, what happens where there's a vacuum, where there's a space to be filled, where there isn't that sort of, organizational bodies to be able to help support. That's where we need the funding to be able to build the capacity, because otherwise you can have an unequal transition. And I think we can see that from the report, is obviously it is unequal, and you can probably map that across the capability and capacity, because some of those sectors haven't had that sort of long duration of having sort of, organizations able to support them.
And actually, in the report, once you'll have the time to digest it all, one of the indicators in the management quality scale where companies score really poorly is that dichotomy between their position at the company level and what they do at the industry level that is not always aligned, so something to watch out for as well. I wonder if, and Claudia, you included, what are your thoughts on, was it Claire's idea of putting climate transition plans up for vote at AGMs, if they make it to the agenda of the AGMs? Any thoughts? Claudia, do you want to chime in here?
Yeah, sorry, I couldn't hear the initial question at all. And so it's about putting up climate transition plans for vote up at AGM.
That's right, yes.
Yeah, I think, I think, to be honest, we would have to look into that, how that functions within the governance system and within the context of the other disclosures of companies. So it's definitely something to be explored, but I couldn't yet give a definitive view on how we would look at that. And it also depends, on the companies in question.
Any other thoughts?
I mean, on the stewardship point, sorry, so it's like, are you then as an investor in that company prepared to walk away from the table if the company doesn't do what you want to do? And I think that's some of the challenges with stewardship on oil and gas. If Equinor claims that they're going to follow 1.5 degrees path, then they don't. Does X responsible investor say, right, we've tried to help move you in the right direction, you're no longer moving in the right direction, and then we're going to walk? It's, are you going to be prepared to walk? It's the sort of, you've got to have back it up with action.
Yeah. Are the different investor team in agreement about that decision as well? That's something to remember. Ali, are there any questions from the audience online? Oh, sorry, David, go for it.
I've also been informed that the audience online can't hear the questions in the room despite these. So if the moderator or
I have to repeat it.
just to repeat.
Yeah, I'll do that.
Thanks. David Harris from LSEG, and thanks for the latest research. It looks excellent. Look forward to reading it in full. Question for Simon, although Marty and Cherry might want to kind of comment as well. So last year, Simon, you said there was a little bit of a wobble in the from the corporates, and there's potentially some pullback, you were saying, particularly in terms of responsiveness from companies. So I was really interested in looking at the management quality score this year. You were saying that actually it's looking pretty consistent relative to last year. I was wondering if you are seeing any kind of pullback, maybe by certain sectors or certain countries, but it'd be interesting just to see, given kind of global geopolitics at the moment, perhaps there might be some expectation that there was some.
Simon, are you happy to repeat the question?
Sure. So the question was, to what extent do we see corporate pullback in the data? Right. I think it's really a little early. So the data that I've presented has been data we've collected over the past year. We would have a better basis for looking at that when we release the next round of management quality data later this year. I don't think we see a lot of it. We see, and here I'm speculating a little bit, I don't think we see a lot of it. I think we see some pockets of it. So I think when we publish our banking report next month, for example, we'll be able to document some specific examples of walking back on commitments and ways in which walking back happens, which in some ways is at least as important as the fact of walking back is actually how are banks and companies doing it, right? So in summary, we see some pockets of this happening, but I don't yet see evidence to suggest that this is happening across the board so that it would affect aggregate data.
Just on that, I ran a call the other day with probably about 50 of our US members, if just as an example, and we sort of polled them to say, you know, are you pulling back? What should you do? Where are you being asked to go? You know, we're talking about CSOs, so we're not talking, you know, where are you guys being asked? Are you being asked to pull back? Are you diverting energy, having budgets removed? And we did it on a poll, so it was you know, no one had completed, so it was them. Nobody, everyone was across pulling back, if not doing more at the top. No one came in at the bottom. And bearing in mind, we are a skewed sample size as the World Business Council for Sustainable Development. But I personally was actually quite surprised in that direction of travel. It'd be interesting to see what you see out of your results when everyone presses the submit button today.
Well, and actually just as a point on this, actually we're sitting here talking a lot about investors and allocation of capital, rightly so. The largest driver of disclosures worldwide is because the customer asks. So again, part of this is actually large companies with big procurement systems and supply chains around the world are demanding this data coming from corporates. And that is very logical because 26 times is the number that scope 3 on average on every sector is larger than scope 1 and scope 2. And so therefore, if you are looking at, you know, a transition plan, which will be a number of years, you really do need to engage with your supply chain. And so if you're doing that and seeing how emissions don't just come from yourself and your own activities, but your supply chain's activities, that is a year-on-year requirement. And I think what we're hearing is that companies are continuing to, at the very least, you know, push for all that information and talk to their suppliers in order to be able to make sure that 2, 3, 4 years hence, that they're actually really on track. So that's the news we're getting.
Along the value chain.
Yeah.
Influence. I think we have time there for a very short answer to a question, perhaps online, because I'm conscious that Chris has to catch a flight, and so we need to finish promptly at 4 o'clock. Ali, please.
Yeah, question online from Georges, research analyst at IIGCC. Question on decarbonization levers for all panelists beyond TRL, so technology readiness level. Would it be desirable to assess the cost of these decarbonization levers, either in marginal abatement cost or against each other?
Not sure we can answer that quickly, but who wants to have a go?
Well, I mean, that sort of wraps up in probably to my final point of what I'd love to see, you know, happen above all, which is transition planning is all well and good, but unless the transition planning happens alongside creating a finance plan, front and center, not as a sort of nice to have on the side, you know, separate chapter, but a mainstream all the way through, you know, recognizing the cost, but also the investment need and the data that's required to be able to deliver that. That's what I've been trying to work on with the Transition Finance Council, is making this case. You know, we came out of the blocks with transition plans. We've got the TPT disclosure framework. You know, so much work now has moved from policy to implementation, but the core driver for implementation will be, can you pay for it? And if, you know, is someone else willing to pay for it in return for a longer term investment over 30 years? And if we can't make that case, then the transition is not going to happen. I think we can see from the report today all the areas where the transition is slow or, you know, difficult, and we're moving to that level now where we've done the low hanging fruit. We've got to be able to have that finance case in place, that investment need, and that's where, you know, absolutely that's got to come into consideration, not just as a sort of like metric in a, you know, in a side of a table. Can we, you know, how can we pay for it or not? But it's got to be strategic. It's got to be there as part of a finance plan with the transition plan itself.
So investors have to, they hold the power to make this happen. Very quickly, because we're at time, I'd like some very short thoughts, Claudia, and what the other panelists, please, on if you were to pick one solution to increase the credibility of transition plan? What will be your call for action? Claudia, perhaps we can start from you online.
Yeah, I'll keep it very short and sweet because I think picking up also or building on Simon's point, this can only be achieved in partnership between all actors that are involved.
Partnership, great. Simon.
Well, when I fed your question into ChatGPT this morning, it told me to say, it told me to say strong, consistent policy, and I do agree with that. But
Now we know the report.
in some jurisdictions, we're just not going to get strong, consistent policy. So I think actually amplifying examples of what works is something we should do more of, because there are lots of good examples of things that actually work, and we just need to diffuse that information around the world.
Share those practices, because I have to say that let's not focus on the laggards, let's focus on the leaders and why they're doing it, why they are being leaders. Chris.
As I said, finance plan mainstreamed into the transition plan from the outset, not as a nice to have afterwards.
Martin.
For me, it's very much building this integrated, removing the silo of climate and integrating it right across the business from the beginning. Because if we keep these climate silos, we're going to end up like we have a bit with disclosure. We just have climate disclosure, and then we have nature disclosure standards, and then we have social disclosure standards. But actually, all these things need to be completely integrated if we're going to get robust, credible, transition frameworks and strategies and financed for the future.
Sharon.
I would say, keep disclosing. What you can measure, you can manage. And our statistics say that within 2 years of the first disclosure to CDP, companies decrease their emissions by 7 to 10%. That's a good first fact. Then we have to keep going.
Great, thank you. But please join me in thanking the panel for their amazing contribution. Of course, read the report, because that's the focus of today's meeting. Join us for a short reception during the coffee break. For those of you who are staying for the workshop, there is also a small drinks reception after 6 o'clock. And please do read also, watch out also for the upcoming reports, the state of transition in banking and the state of transition in sovereigns. Thank you for joining me.